Good morning, everyone, and a very warm welcome to our workshop on Tax Hacks 2020. Inviting you for this power-packed workshop to help you understand the various nitty-gritties of taxation, investment, wealth creation, and goal setting. So may I take an opportunity to introduce our guest today, Ms. Swati Raina. You must have seen her a lot on TV, especially Z Business at Money Guru. A hearty welcome, Swati. And
thank you.
Hi, Swati.
Thank you so much. Thank you.
And we have Mr. Dipen Sheth. He heads our strategic marketing and equity research. So he's been associated with HSL for a very long time. So over to you, Dipen and Swati.
Thanks, Pratibha, and welcome, Swati. It's great to have you. We don't want to have a very formal walkthrough here. It should be more of a conversation, and it should be a conversation even with the audience, because right at the end we are going to carry questions. So we are thinking of how to figure out a way to hack this entire hurdle called tax in our lives as individuals, and mostly as salaried individuals. A few of us here are businessmen. But mostly salaried individuals, right in the middle of COVID, kicking off the Navratra season, call it Durga Puja if you will, and over the next few minutes, Swati and I intend to walk you through how to hack this business of tax. Nobody likes paying taxes, but you need to stay on the right side of the law, pay what taxes you need to, and plan to minimize your outgo. And what's more interesting, as people in the broking industry and investing industry, the message that we have for you is don't just save taxes, become a tax hack and create wealth in the long run with those little savings that you do every year. And there are some 6, 7, there are some 7 big products. We'll come to the details, but the big message we have for you is that you should be creating long-term wealth, medium to long-term wealth with your taxes. Swati, any
absolutely.
thoughts?
So yes, absolutely. Tax planning is never easy. People are always confused how to save tax. And yes, what are the ways to save tax? That's why you have called it tax hacks, and that's a very good name. And it's not just about saving tax, but yes, creating wealth as well. Because
right.
The reason what people do, they just invest to save tax. So be it all the products we'll be discussing in another 1 hour span. What they do, they have just tax planning in mind, and then they invest. They don't think about creating wealth as well as saving tax. Yeah. So that is what we are going to simplify today in our webinar today, how to create wealth as well as save tax also. So both the goals should be met equally, not just one part. Yeah. And there are many ways to do it, and very simple ways to do it. And it's going to be an interesting session.
Okay, great. So let's get started. There we go. So the thing is that a tax hack thinks medium to long term. Now I've tried to define what short, medium, long term means here, and you need to choose well here. Okay, there's a short term horizon for planning your wealth, your spends, your lifestyle. So in the next 3 to 5 years, many of us are thinking of buying a car, going on a vacation. Well, with Corona, I think that's a little doubtful right now, but repay some of the debt we are carrying, or repair our homes, live a little better, right? That's what we all want to do. Now, notice that the 2 boxes in the middle are outlined in red, and that's what is going to be relevant in today's webinar. So some things you plan over the medium term, 7 to 15 years, and even the definition 7 to 15 may change depending on whether you are 23 or 43, right? But मोटा इस तरह से कुछ होता है कि 7 से 15 सालों में अरमान ऐसे हैं कि भाई मैं एक घर खरीदूंगा, या कम से कम एक डाउन पेमेंट देता हूँ, बच्चे को, खुद को, हस्बैंड को या वाइफ को फिर से पढ़ा सकूं, कोई additional qualification we can have, plan a second child, support my family, whether it's parents or a sibling or somebody in trouble, figure out. Okay, so that's what plays out in our lives over 7 to 15 years. Then long term, which is even more important, hence the line there is bolder, the outline. You need to marry off your kids. That costs real money nowadays. Okay, you need to have some money stashed away for your retirement. well, I've got this fabulous new idea, so I need some startup capital. I need to live well, for God's sake. Now I want that, some comforts in my life. I don't want to live in one cubby hole apartment right in the middle of the city. I want to get out into the suburbs, buy something spacious. Okay, I want to live well. And of course, there is nothing like short, medium, or long term when it comes to emergencies and accidents. These keep hitting us all the time. Now, these are the things at the back of the tax hacker. Even the emergency requirements, medical requirements, as you know, can happen during Corona, job loss. God knows it's happened to quite a few of us. A
Yes, it
calamity
has.
such as a flood or a fire or something. And of course, families and friends of ours go through emergencies. So, Swati, the message I have here, and tell me if you have a thought, is that ultimately it's about my financial life that my tax hacking philosophy is addressing. That's the thing that at the back of my mind when I'm doing my tax hacking.
Absolutely. So when we say investment planning should be goal-based, tax planning should also be goal-based.
Right.
It is very important. And when we are looking at different time frames here, so we have a very short term, like which we have buying a car, which we can actually shift it to medium term also, depending on our situation, or a vacation, which is like more of an aspiration these days. So it can be also delayed. Repay debt is very important. That should be top of the priority. And home repair. Of course, we all are working from home and we do see little bit cracks here and there. And we need to repair our homes these days because workplace is also our home place these days. Having said that, when we talk about long-term goals and we have children's marriage, so someone who is still or in his or her 30s, maybe they think children's marriage, maybe children, they can marry themselves off after like 20 years or so now, or 30 years. So maybe long-term planning for someone who is 30 years old right now can be a different goal in terms of long-term planning. So yes, definitely children's marriage is important in terms of investment planning and tax planning, but retirement corpus, I feel, is extremely important for all of us.
That's the big, what should I say, bull in the China shop. Nobody thinks about these things, but eventually when you are 60 and you want to stop working, you're 55, you want to take early retirement, you better have some money in the bank, my friend. Nobody's going to hire you at 55 and starting a business, getting a regular income. So yeah, retirement corpus ke baare mein sochna bahut zaruri hai.
One point here I would like to make. There are a lot of people I know, and there are a lot of questions I keep on getting is, and that's a concern, that people have been laid off in their 50s. When they were close to retirement, they were laid off because of numerous reasons we all know, because of COVID situation. And they didn't have a retirement corpus, or they were near, realizing their goal. So now they are falling short of their retirement corpus and they are really concerned what to do now. So yes, again, that hence proves that how retirement planning is very important for all of us.
The regret you might have is कि इतने सालों में अगर थोड़ा सेव किया होता तो आज मेरे पास 10-20 लाख रुपए ज्यादा होते, whatever it is, किसी के पास ज्यादा होते, किसी के पास करोड़ ज्यादा होते, but होते, और वो अगर 58 की बदली अगर 52 पे अभी रिटायर होना पड़ा है, let us say, and if you've been saving from 32 to 52 and versus if you haven't been saving from 32 to 52, the difference can be, crazy.
A lot.
So I think this long-term financial, I won't call it conjuicy, but this long-term financial tight-fistedness, this conservatism is especially called for. We are going through a period right now when we've realized कि दादा दादी को अगर हम कंजूस कहते थे तो कुछ गुण था, उनका जो हमने मिस किया. And a lot of us are now spending less. Of course, we are forced to spend less. The avenues to spend have, all but evaporated. But yeah, these are some of the virtues underlining the typical tax hack behavior, if you ask me. And these are the big things to live for. And one of the ways you can go there is by becoming a tax hack. So okay, quick look now. I flipped slides here. Look, again, I can't tire of giving this message to you over and over again. A tax hack saves taxes plus creates wealth. And medium to long term, not long term is underlined. That 10 to 15 year thing, 20-year thing is what we are really attacking, because you do a little bit every year and it adds up, it compounds. Okay, so here are the super seven. Of course, there's maybe about 50, 60 ways to save taxes in bits and pieces, bits and spurts. But the super 7 of tax saving. These are the 7 big products that apply to salaried people. There are finer details, and if you go to a chartered accountant, he'll give you another 70 maybe, but he or she. But these 7 are really what cover maybe 70-80% of the ground. And these are the asset classes. If you look at the right hand side column, this is where the financial savings that you build up in these instruments or products in the super 7. This is the kind of asset class in which that money goes. Okay. So you may put money in an equity linked savings scheme, which is a mutual fund product. You may put it into a tax saving FD or fixed deposit with a bank. With health and life insurance, you don't only get savings, but you get protection. Insurance is all about protecting against the unforeseen. Even health insurance is a savings product. You'll be surprised when I say this, because it's indirect savings. मुझे 5 लाख रुपए एक ऑपरेशन का नहीं लगा क्योंकि मैंने हेल्थ इंश्योरेंस लिया था. Okay, and of course life insurance and the unit linked insurance products and plans. So ULIPS, as they are popularly called. So that's again savings plus protection. Okay, some of your money you crib about it every month on a salary slip कि भाई EPF कटता है मेरा भी contribution जाता है, employer contribution जाता है. So that's EPF for you. These are some of the these are virtues. Okay, so don't crib about the fact that you're paying EPF. You're not paying, you're accumulating. Remember that. It is stopping you from spending money today. Similarly, PPF, this is a voluntary scheme. And of course, I think the big monster there is National Pension System. NPS, sadly, Swati, it's the least known and it's probably the most important.
So I don't consider this, of course, it's super 7, but yeah, this is not a priority list, of course, yes. And we have not prioritized it as that is ELS is not being number 1 and NPS not being number 7. But yes, it's important, and rightly said, it is super 7. Just before moving on to the tax part of it, emergency, like what we were discussing in the previous slide, it is very important in today's time. We all have realized that if we had not saved for, and if we still have not saved for emergency, then yes, we all are really in trouble times. But yes, having said that, when we talk about the tax saving instruments, yes, we have a lot of them, just super 7 being some of them. But yes, we're just talking about a bucket of 1.50 lakhs only. But and should we get, and how do we get more than that? Tax saving is all about saving more and more and more. And people keep on asking, सबसे ज़्यादा से ज़्यादा tax हम कैसे बचाएं? उसमें सबसे पहला जवाब तो यही है कि जितना जल्दी आप tax planning कर सके, उतना is very important. We keep on telling our viewers as well, tax planning is not just about बिल्कुल लास्ट में अरे कल आखिरी डेट है और एक दिन पहले हमें टैक्स प्लानिंग करनी है. लाइक आई थिंक दिस यूज्ड टू बी आवर आइडिया व्हेन वी यूज्ड टू स्टडी फॉर एग्जाम्स कि अरे लास्ट टाइम प्रिपरेशन कर लिया, कल चलो एग्जाम देना है, कम से कम कुछ याद तो रहेगा. तो टैक्स प्लानिंग इज नॉट अबाउट दैट. यू हैव टू डू इट थ्रू आउट द ईयर to be able to reap the benefit out of it. And yes, of course, we have a lot of instruments, a lot of wonderful instruments, EPF being one of them. The biggest reason I'm categorically pointing it out is because EPF has been, हमने इसको बहुत easily बोला है, कोविड में संकट का सहारा EPF बना क्योंकि आपका पैसा EPF में करता था. Being someone who is a salaried employee, a lot of people were able to take out money, which I don't think is a right thing, because if you are digging into your retirement corpus, it is never a right thing to do. But yes, they did have an option to do that, only because your contribution is there in the EPF. But yes, PPF is there, but again, 1.5 lakhs, that tax bracket of 1.5 lakhs.
Yes, so it gets into that umbrella, that ETC umbrella. So we'll come to those details in a minute, but I completely take the point that a corpus is there for dipping into at times of real need. Now, what is a real need and what is not is subject of judgment. But yes, it's useful to have that money stashed away. Perfectly agree. You know, the other thing is that I'm taking you to the next slide here. We are jumping quickly now. So the big deal also this time for the tax hackers is that this was the budget. The last budget was the budget in which we actually were given a second tax regime. Okay, there was an old regime which continues, and which is what is applicable for the tax hacks. So Nirmala Sitharaman's budget also gave us a new regime, and we can choose between the two. If you want to become a tax hack, then you have to. You have to stay with the old regime, which gives you exemptions, okay, which gives you a possibility to reduce your tax outgoes, and it incentivizes a certain kind of behavior as it does so. Of course, if you say, no, I want all my money liquid all the time, I want to do what I want to do with my money, and I will not invest into tax saving instruments, I don't believe in them. Well, if you, agar aap is cheez mein nahi mante hain, to of course you can choose that. You will get lower rates, but then no tax exemptions, no savings out of those instruments. And as you can see in the box there, the difference between the two regimes in terms of the tax slabs, okay, is so the left hand column, the middle column of course is your income, and the left hand column is the old rates, the right hand column being the new rates. So it's basically the 5 to 15 lakh rupee income range in which the rates vary, and the new rates. So once you're beyond 15 lakhs per annum in your income, it doesn't make a difference. You will make an initial difference in the part between 5 to 15 lakhs, and that's about it. Now the interesting thing is that for most people who are making more than 15 lakhs per annum, they are going to be good savers anyway, unless they're supporting a very rich family, very lavish lifestyle. So I suspect that trying to become a tax hack makes sense because you have that liquidity. Okay, very easy. That's my thumb rule. If you're making, and it's a simple thumb rule, there can be exceptions depending on your circumstances, your lifestyle, your spending habits, and so on. But if you're really making 15, 17, 18, 20 lakhs per annum, don't even bother about going to the new rates, because I know you can save some money unless you're in some real distress with the rest of the family, or you have a very large or extended family to support. Be a little bit of a conjuice and become a tax hack, as it says on the left-hand column. And the kind of behavior which the tax hacking regime, if I can call it that, the old regime incentivizes, and which continues. It was there last year, it's going to be there this year and next year and so on, is of course you'll get a few deductions related to job-related expenses such as transport or mobile bills and food. And these are, small ticket items. But you do get incentivized for doing a bit of well-being, which is you put money into medical insurance, you immediately make a tax break there. Certain expenses like rent and education, of course. And of course, you make a donation to PM Cares Fund or whatever it is, and you get an exemption there. Put some money aside for education of your kids, higher education, and so on. There are some incentives there. Some incentives, of course, with conditions applying, as I put stars there for your benefit, asterisks. So even on home loans, the principal repaid and the interest that goes out and all of that. So there are complicated clauses which tell you exactly how you can save. But again, the last two items, the short and medium term savings, that's in bold. So from our list of 7, the ELSS, FD, and the NSCs, and so on. So that's your short and medium term savings, and the long term savings, which is very, very important. Your life insurance, your ULIPS, EPF, PPF, NPS. We'll come to those. So that's the thing. Now, this is the time in the webinar where you got to choose. Okay, Swati, and that includes you. Do you want to be part of the old regime, in which case you're a tax hack like me? Okay.
Absolutely.
Otherwise, this is the time to switch off the webinar if you don't want to be a tax hacker. And you can choose the new regime. Good luck to you. We respect that. But that's not quite what we're going to talk about today.
So yes, taxpayers or no taxpayers, we have two options in front of us right now. But what was the need for a new tax regime? So are we moving towards a no tax system in coming years? No one knows. But yes, we have a system in front of us where you can be paying no taxes and just have all your money for yourself or expenditure. But yes, tax planning, I feel, is not just about paying taxes, saving taxes, but also about discipline. As you rightly said, we will be putting some money in insurance for our हमारे अस्पताल का खर्चा और all those things. We will be spending some money somewhere in buying a house and getting a rebate on it. So this all falls within our goals as well. So that creates a discipline in our life. But yes, if you don't want to do that, you have a new tax system. But yes, that makes more sense if maybe you don't have any obligations. You don't have a house, or you are fairly young and you want to have all your money. You want to buy a new phone, iPhone 12. So you can just feel that, no, I don't want to save tax. I want to have more of money in my hand. Or people in this situation. good life for some time. Maybe they can experience that, enjoy that, because you have that flexibility also to be part of new tax system and then shift back to old tax system. That is allowed in one financial year. So having said that, yes, I feel tax planning is very important and it creates discipline in your financial life.
So here's the first of the Super 7, the ELSS, the mutual fund that helps you save taxes. And, you know, this kind of mutual fund invests about 80% into equity. It's out there on the slide, okay? And you are forced to put in money for a period of as short as 3 years. This is, in fact, the smallest lock-in that you get among the tax saver instruments, okay? In fact, this often prevents jittery exits. I know so many people who put money to a mutual fund, they're down in the first 6 months and they say, "Arey boss, paisa nikal lo." But this forces you to boss 3 saal. And then, of course, the invested amount is exempt from taxable income. This is part of the exemptions that are available under the ATC umbrella. So that all the instruments that you invest under for tax savings within the ATC umbrella, so up to 1.5 lakhs you can put here. The best part of the ELSS is that even the income, which is the profits on redemption, are tax-free up to 1 lakh rupees per annum. Okay. Now, this is a super part which is less known. Okay. So note that the tax saving instrument has tax implications in 3 dimensions. When you invest, do you get tax savings? Okay, so that's exempt. EEE. So ELSS is at the time of investing, there's an E. When you earn income on it, it's E, which is exempt. And then finally, when you redeem it, it's exempt. So it's exempt, exempt, exempt. Okay, but it's subsumed within that 1.5 lakhs. Okay, that's the thing about ELSS. And yes, 80% money getting into equities. If that's your style, then you should be doing this. Equities, you should, I think, wait for a minimum of 3 years before you can rationally expect return. And of course, the usual conditions apply on the risks of equity. You know.
Absolutely.
So here's the second one. I think this is less. This is the exact, I would say, mirror opposite of the ELSS in the sense that you're going completely into debt. Swati, your thoughts on tax saving FDs? Is this an unglamorous or silly thing to do?
It's not a silly thing to do. See, we cannot call people who have been saving tax in FD that they have been doing a silly thing. And we know that it's been a traditional tax saving instrument. It's still a favorite one. So we should not argue on that part. But yes, we do have other tax saving instruments as well. We do have benefits of in saving in tax FDs.
Assured returns, of course, here. That's the
assured return. Yes, we do get assured returns. Yes, and people who don't want to be really risky in their investment or tax planning, like we just spoke about ELSS. So beauty about ELSS is that beauty of ELSS is simple, that you do get tax benefit, but it can be part of your portfolio as a short-term or a mid-term goal as well. So that's a dual purpose that ELSS solves. But if you don't want to expose yourself to market risk, there are always FD. So for an investor, you do have a lot of options, but is this the best option? No, I wouldn't say that this is the best option. We do have other options as well that can serve your purpose well.
Here's another one, health insurance. So, by the way, this goes beyond the ATC bit. While the tax saver FD is covered under the ATC 1,50,000 umbrella, health insurance up to 25,000 rupees. Look at that fourth bullet point, and you can add another 25,000 for senior citizens cover that you buy for your parents if they are above 60 years. So this is section 80D. So you can get another 50,000 exempted from your taxable income by putting money, I won't say investing, but by paying for health insurance. And you know, we think कि अरे boss ये पैसा तो चला गया, ये वापस कभी नहीं आएगा. Okay, जब आएगा तब कहकर नहीं आएगा. You know, because if you are covered और 2, 3, 4, 5, 10 लाख रुपए अगर लग जाते हैं हॉस्पिटल में और आपको उसमें से कुछ नहीं देना पड़ा या बहुत ही कम देना पड़ा, that's when you realize, oh, it was a great idea to put that 25 or 50,000 away into health insurance. This is a protection product, okay, and it has an indirect impact on your savings, and the impact is that it prevents large emergency payouts. I hope you are covered on health, Swati.
Yes, of course, all of us have, and more people are actually covering themselves. And the recent data also indicates that people are buying health insurance like crazy. Of course, we know the obvious reasons. COVID has actually forced us to, which is a very sad situation. We shouldn't be forced to buy a health insurance, but that should be part of our financial planning. and that should be the first and foremost thing. But yes, of course, we do get benefit out of it also, but we shouldn't consider it as that कि हमें तो इसका benefit मिल रहा है तभी हमें health insurance लेना चाहिए. Health insurance हमें सबसे पहले लेना ही लेना चाहिए. Pratibha wants to say something.
We can't hear you, Pratibha, or I don't know something.
I just want to make a small request. A lot of guests in the audience have requested for English. So a small request to, drive the conversation in English.
Yeah, I didn't even notice I was breaking into Hindi. Sorry for that. Yeah, sure. All right. Okay, so health insurance, definitely another one of the Super 7. And which brings me to life insurance and ULIPS. So this is something that most people are uncomfortable talking about, in case of death. And people are scared to talk of death, but I think this is something we should protect ourselves against and our families against. A term plan is a pure protection, product where you pay only for the life risk. I think life insurance is something which is indispensable, especially when you are young. As you grow older, maybe you crossed the need for it when you are 55 or 60. You say, what do I, do with? And anyway, life insurance becomes costlier. So you must start early. And you can also build a savings plan, as it's the technical term for which is an endowment plan. So you get money back at the end of the term, and with some guaranteed returns and some bonuses. Of course, you can also get into market-linked returns, which is what a ULIP does for you. And like I said, this will also fall under the ATC umbrella limit of 1.5 lakhs deduction. So there's only so much that you can save in taxes by putting money into life insurance. Even if you go beyond the 1.5 lakhs, the tax benefits don't accrue, but you continue to enjoy the protection that life insurance gives you. I think life insurance shouldn't figure in a tax instrument or tax saving approach as much as it should figure in a, because I'm going to use the 1.5 lakhs umbrella anyway, even outside of life insurance. That's what most responsible people do. Right, Swati?
I agree to your point, Dipen. Life insurance should not be part of your tax planning as such. If you're planning if you're thinking of 1.5 lakhs, that you have to save 1.5 lakhs, so you shouldn't think of life insurance as part of that.
I've lost you.
We can hear you, Dipen. Yes, maybe a little loss of connection in between, but yes, we can hear you. But yes, I agree with you on this point that yes, life insurance should be over and above your 1.5 umbrella of tax saving, and it should be just purely for your protection and not for the purpose of tax saving. I feel that. Do we have Dipen with us?
Yes, the pain is still there.
Sorry, we seem to be in a bad connection here.
But we can hear you. We can certainly hear you.
Yeah.
And what is the thought about ULIPS, Dipen?
Dipen, can you hear us?
Me? Hello?
Yeah, we can hear you. We cannot see you well, but we can hear you.
Okay, so I'll switch off my webcam because hearing me is more important than seeing me. Okay, is this any better now? Is the audio coming through at least?
Yes.
And is my screen visible to you? So I'm back on the life insurance slide. Okay. Right. So
yes.
the next tax hacking product that Swati, sorry, you had a question on ULIPS, I thought.
Yes, I had a question on ULIPS. So what is your thought on ULIP? Because again, you just mentioned that it's most misunderstood product. So what about ULIPS?
So on the ULIPS, I think if you have equity sense and if you do believe in the long-term compounding capability of equities, then taking an equity-oriented ULIP plan is a wonderful idea because you're doing it for many years. That discipline is lacking when people get into mutual funds. They get in and get out of funds. But with a ULIP, you're forced to save in equity instruments. And of course, you can change the flavor between debt and equity in ULIPs across as you move forward in time. But I think a ULIP is a very good idea. And after the first 5 or 6 years, actually the cost that you have to incur for fund management actually comes down substantially, and it works out to be a cheaper product, especially with the tax savings that you get on them. Okay, so that was my thought on ULIPs. But finally, 2 more debt instruments with reasonably high yields in the tax hacking wish list, which is PPF, which is the Public Provident Fund, which is a voluntary thing that you can start on your own. You don't need to do it through your employer. And the Employees Provident Fund, which is the EPF, which of course your contribution is visible on your salary slip. The current rate of return that is fixed by the government of India on this product is 8.5%. Both of these products, PPF carries 7.1 right now. Both of these products are triple E category, exempt, as well as they both fall under the 1.5 lakhs limit. They're wonderful products, but if you've already used your 1.5 lakhs limit, you can earn returns from these products, but you won't get the tax breaks above the 1.5 lakh umbrella limit if you've already used it with other products. Okay, and most of us don't have a choice on EPF, and many of us with the kind of salaries that we are at will end up using more than a substantial part of the ATC umbrella within our EPF contribution, if not exhausted completely. So these are less glamorous products, but lovely products, and they turn out to be very helpful at times like this.
Yes, absolutely. So PPF and EPF, being EPF, of course, is mandatory contribution. We have just spoken about EPF before this. Just to reiterate, of course, it is very important, and it actually attracts highest interest rate at the moment, 8.5%. But yes, if we talk about PPF, it used to be very, and in fact, it still is very popular.
Right.
As far as long-term investment product is concerned, and as well as tax saving instrument is concerned. But yes, 7.1 interest rate is not that glamorous, like the word you use is not as glamorous as we expect.
Yeah, but Swati,
yes,
there's a context,
expect
banks
our
are giving
product.
So banks are giving
Absolutely,
5%.
yeah, that's what
So I think 7 is not a
to.
bad deal, really, especially when it's tax-free.
Yes, yes. But as compared to what other instruments we will be speaking about next, or we have available at the moment, PPF, it's falling interest rates. We can't do much about it at the moment. And people who just imagine who have had put their money into PPF many years back, just getting 7.1 interest rate is not that much. They must be expecting they must not be expecting that.
That's something we'll have to settle for, even on the bank FD rates. And, we are getting into a lower interest rate regime now, and we'll have to reconcile with this. The consolation is, of course, that inflation has also fallen. I'm not talking about very recent trends, but structurally, it does look like we are in a softer inflation zone than we were, let's say, 10 years ago. So maybe lower interest rates don't hurt us so much anymore. Anyway, we can have these arguments forever till the cows come home. But here is the least known and the most powerful weapon for tax hacks. There is super long-term accumulation, because you can accumulate and compound till age 60. You get huge and exclusive tax benefits. We'll talk about that in a minute in the next slide. Which goes way beyond. These benefits go way beyond just that ATC 1.5 lakh limit, which anyway clubs in a whole lot of instruments together. You can also put in the NPS contribution into that 1.5 lakh, but you can go beyond with only NPS. That's the big deal. The lovely thing about NPS, which again most people don't know, is that it just charges 1 BIP for managing any equity class of fund that you choose, whether it's equity or corporate debt or government debt. They just charge a 0.01% per annum fee, 1 BIP fee versus 200 bips plus for the average equity mutual fund out there. This is absurd. I mean, this is absurdly cheap. That's what I mean. It's very, very tax efficient. And even on the maturity at 60 years of age, you can withdraw 60% of your accumulated, savings plus returns, what we call the corpus. You can withdraw it tax-free at maturity when you are 60 years of age. So 60 at 60 is tax-free. That's the way I remember this. And even during, tenure, Partial withdrawals of up to 25% of the voluntary contribution are exempt. And there's a flexible asset mix. You can go all the way up to 75 in equity, or you can have 0 in equity and 200 in debt. And you can flip this as many times as you want to during, now and 60 years. Right now, the returns look pretty decent, Funds on an average, there are many fund managers in the NPS. There's SBI, there's HDFC, there's ICICI, and so on. But the equity funds there have returned something like 7.8% over the last 5 years versus 7% for Nifty, which is a very good and creditable performance. The corporate bond fund has given a whopping 9.5%, and government bond fund. Here is the beauty of falling interest rates: 10%. Wow. Okay, and my money is compounding at 10%, and it's going to be tax-free when I pull it out. Even the returns are tax-free right now for me. Fantastic product, and I haven't even got started on the additional headroom for tax savings. Even from a pure returns perspective, this is fantastic.
Absolutely. So, like we are discussing NPS and what we previously discussed about PPF, both are long-term investment products, cost come tax investment products. And of course, people will want to know what the difference is, PPF as compared to NPS. NPS is, of course, fairly a new product. It was just in 2004 it came. So, of course, we are just still talking about it came in the new millennium. And maybe that's why it's not that popular. Maybe, and it's still slowly picking up now. But yes, when talking about the tax efficiency part of it, it does a good job. 60% of corpus. So when we talk about, so there was a lot of confusion among investors. So when we talk about total tax-free, NPS is total tax-free. It's just the 60% part of it, not the 40% part of it, which goes into the annuity and which eventually pays you monthly. So which is, again, a very good thing. And as you rightly said, you can go as high as 75% in equity and benefit enjoy the higher interest rates of equity as well debt and other instruments as well. You wanted to make a point here, Dipen?
Here's the big deal about NPS and why I'm screaming about it from the rooftops. The thing is that over and above, so look at the last row of this box first. That ATC limit, a tax deduction of up to 10% of your salary, which is basic plus DA. That's my definition, or that's the legal definition of your salary. That 10% contribution from your part will get into that 1.5 lakhs under the ATC anyway. Okay, but there is no limit on absolute contribution. The tax benefit is capped at 10% of salary, and this is clubbed with the other ATC investments. Okay, now this is the plain vanilla benefit under NPS, but the starred items in the first two rows. The first one, if you look at the top row, you go over and above the 1.5 lakhs limit, you get another 50,000 headroom, which no other product gives you. So you can get now not 1.5 lakhs. Let's say you've exhausted your 1.5 lakhs in the other products. You can put in another 50,000 to take it to 2 lakhs. This is section 80cc 1B. Okay, and this is available only through NPS, no other way. So now that 1.5 lakhs goes to 2. And hey, look at the middle row, 2 stars now. Okay. The employer contribution over and above ATC, which can go beyond the 2 lakhs utilization of the ATC limit. This comes under a section called ATCCD2. You can take this to 7.5 lakhs. Look at that third column in the middle. Okay, the cap there of 7.5 lakhs comes in the sense that the employer contribution to your EPF plus the employer contribution to NPS plus the superannuation contribution, which in most companies happens after 5 years of employment, otherwise it's not there. This goes up all the way to 7.5 lakhs. So you can do a whopper contribution of theoretically another 5.5 lakhs after your 2 lakh utilization. Of course, you'll have to deduct your EPF. So let's say your EPF contribution during the year by the employer is 80,000. So 5 lakhs less 80,000. Superannuation another 20,000. So knock off that 20,000. But that's another 4 lakhs even otherwise. So it will vary from person to person, but there is typically going to be a few lakhs more of headroom here. This is a monstrous thing, especially when you see that from age 30 or 32 all the way to 60. This is going to save you taxes like hell. and the compounding benefits for 25, 30 years. This is crazy. Now, this is the big whammy. This is the big cannon here. I can't emphasize this enough, Swati. And you know, if you get that middle row, the scope of that middle row, you'll figure out that nowhere in your tax hacking endeavors and efforts is this kind of a bullet or a cannon available to you.
How those who have missed the bus now, because it just started in after 2000, they have already missed the bus, and
Oh,
who
that's okay.
in fact invested before that in a long-term product, would they be investing in another long-term product, locking their money, like people who have invested in PPFs, or they have locked in their money and they're thinking, okay, our money is gone for these many years, not gone, I would say, but yes, if they're not getting as much
Stashed away.
return as they yes, of course. So would they be locking their money in another product like NPS? Of course, NPS is like we just mentioned, its features, they are really good features, but two long-term instruments in investor's portfolio?
Of course, yes. And I'll tell you why. Because if you are going to save beyond 2 lakhs, if you're in a position, if you're in a job, and if you're in a family lifestyle situation where your income less your expenditure does leave you 2 or 3 or 4 lakhs at the end of the year, uh, if that's your life equation right now, then you should be doing this, even if you're 45, even if you're 50. Okay, not just if you're 32. And of course, if you're 32 and you're the bright kid on the block who's making an income where you've got, even after your 1.5 lakhs tax planning and your lifestyle, if you've still got some money saved, of course you should do it. But if you are 35 or 40 or 45, you should still be doing it if you have the headroom. You know, you can save when you have savings, and if you have those savings, then you should save taxes and you should accumulate for the long term, even if you're doing it in some other instruments under the ATC umbrella, because this is a big whopper and this is going to compound crazily for you, and this is going to be that nest egg that is going to be useful for you when you are 60 years of age. I can't emphasize this enough. It's most recommended. Okay. I will now pause, and having said that, we walked through all the tax hacking instruments. You will have to allow me, Swati, a little bit of a luxury of promoting my firm. This is the only slide on which I will do it. And that is that, why should you be doing this with HDFC Securities? So for the record, look at that third bullet point. You can do the NPS paperwork, so to say, on screen now. You can open a digital account at hdfcsec.com. You can ask your employer to contact us and add you in the list of employees who are covered by NPS in your firm if we already have a relationship with your firm. Otherwise, we are happy. I think Pratibha will be more than happy to initiate that relationship if it doesn't exist with your employer. But the other reasons, of course, is that this is part of the bigger deal that we offer at HDFC Securities. You know, you can invest in equity, you can invest in debt, sovereign gold bonds, for example, which is the flavor of the season as we speak, mutual funds of all kinds and brands, commodity investing, currencies, insurance, global investing. You can invest in US equities through us if you want to, and of course NPS. So it basically, so what we are offering people is a 360-degree investing, savings, and a financial planning toolkit and a solution. Okay, so open that NPS account, open an HDFC Securities account, buy, sell, settle your transactions, everything in one click across all those instruments above at hdfcsec.com. This is the only promotion I really want to do. Okay, Swati, your comments here.
I just would like to know, as an investor, because a lot of people ask us, because it's all about ease and we are going digital. So when we talk about opening an online account, how simple is it? What are the points one should have to follow before opening an account?
So the NPS account has its own requirements in terms of documents that you need to attach or upload, and the broking account and plus DMAT account, we now call it an all-in-one investment account. So the broking plus DMAT account, whether or not you are a customer of HDFC Bank and whether you have a savings account there or not, of course it helps immensely if you are already a bank customer, an HDFC Bank customer, but even otherwise, we are happy to open your account. The last I had measured, it takes precisely 10 minutes to open an account. You need to gather, of course, your PAN card, and you need to have a mobile linked Aadhaar and so on. We are making it not very easy, but sufficiently easy for you to open an account and get cracking in 10 minutes, 10, maybe 15 minutes. I have a feeling even my mom can now open an account in maybe 20 minutes. Okay. It's easy enough, I can assure you. And if you're not very screen friendly or tech friendly, we are happy to do it using paper-based forms as well. We have more than 200 branches across the country. In fact, you can walk into any one of the 5,000 plus HDFC bank branches and say, hey, I want to open an account with HDFC Securities. You know, that fellow called Dipen has told me I can do this, and I'm sure they'll entertain you.
So you think it has become really attractive now, NPS now, as you initially said, though it's not that popular, but yes, with all the efforts by the government, it is becoming, because we do get a lot of questions asking how is NPS going to benefit us, though we have discussed all of that now. But after this, it is actually...
We lost
Are we hearing
you.
Dipen? Yes.
We lost you.
Yes, Dipen.
Not yet.
Problem, we are still dealing with the technology breaks.
Yes.
Still getting used to it. That's the new normal we all are facing.
Yes, absolutely. Dipen, are you there by any chance?
Yeah, can you guys hear me now?
Yes, loud and clear.
And hopefully you can now see me as well, right? So yeah, just to come back to this thing on NPS, I think the big deal here is that this has got the single biggest impact on your tax planning, and this is the only instrument in which you get another, 5.5 lakhs of 6 lakhs of potential upside. You can take up that 1.5 lakhs ATC limit all the way to 7.5. So that's about 6 more lakhs of additional headroom for your tax exemption. You need to have the income to do that. Having had the income, you need to have the savings to be able to do that. But if you have both of these, you must do it. There is nothing else in the legal domain, okay, that allows you to save this kind of tax money. And if you do this with 6 lakhs every year, God knows how much money you will have accumulated over the next 10, 20 or 30 years, depending on how old you are. So at 60, you will really bless me and thank me for having said this to you. I can assure you that. I think it's time to take questions.
Yes, we surely can.
We have many questions.
Ouch.
So there is a very recurring question that we have, that a lot of our audience is wanting to know the clarification of the employer benefit on NPS, wherein we already discussed about having a combination of superannuation plus EPF plus NPS. So audience wants to know a lot more about it, a bit more about it.
So let's say, okay, so let me give you an example, okay? So let's say my employer contribution to EPF is 50,000 rupees per annum. I'm just choosing round figures, okay? My employee contribution will also be, right? Okay, but the employer contribution is 50,000. And the superannuation is, let's say, 20,000. Okay, so the employer contribution to EPF 50,000 plus superannuation 20,000, that's 70,000 is already taken up. Okay, and let's say across my PPF and my ELSS and my life insurance and all of that, I've already utilized my ATC headroom of 1.5 lakhs. Now what do I do? Okay, so my 1.5 lakhs I deduct from my income. I utilize another 50,000 tax benefit by putting money into NPS. Okay, that's my voluntary contribution of 50,000 there. So I take up my ATC utilization from 150, which would be capped normally at 150, all the way up to 2 lakhs. Now I'm at 2 lakhs. Okay. Now, what is my scope to take it up to 7.5 lakhs? So 50,000 employer contribution to EPF can't utilize, 20,000 superannuation. So that's 70,000 can't be utilized anymore by me. So I'm at 2 lakhs. I've got 5.5 lakhs more to utilize. I deduct 70,000 from my headroom of 5.5 lakhs. Okay. So I'm at like what? 4 lakhs 80,000. So I can actually put away another 4 lakhs 80,000. And I can tell my employer 40,000 per month into 12 months, 4 lakh 80,000. Just take this money out. The question I have is, Pratibha, but we are already in October. And what if I didn't start this in April? Can I tell my employer, instead of 40,000 for 12 months this year, can you please do 80,000 for the next 6 months? Is that okay?
A backdated entry is certainly allowed. A lot of employers do provide this facility to their employees, just in case if they have missed their bus, they did not recall of starting their investment in around
In
April
April.
or May.
Yeah.
So employees always have this window, and this is within the provision that we can do a backdated earlier contribution for the employees so that they don't miss out on the benefit.
I think it's a little demeaning to call it backdated. Hell, instead of 40,000, I'm taking an 80,000 hit every month. I mean, you shouldn't call it backdated. You should call it a makeup effort.
Makeup effort, absolutely.
Right.
Yeah.
So I can make up for lost ground this year when I start my October salary, okay, in November, and I can say, instead of 40, can you please deduct 80, or whatever the arithmetic is that works out. But yes, by all means, utilize that first 50,000 from 1.5 to 5 lakhs, and then in the remaining 2 to 7.5 lakhs, you've got a headroom of 5.5 lakhs. Just deduct the employer contribution to EPF from that 5.5 lakhs. Deduct the superannuation contribution, if any, from that 5.5 lakhs, and that's the number that is still available to you as headroom under your NPS. And hey, divide that by 6, and for the next 6 salary slips, tell your employer to do this. We've got what, 1,500 corporates who have signed up with us. I think the last number was close to 2,000, Pratibha.
Absolutely, yes.
Right. So there's 2,000 corporates who are signed up with us, and there are thousands and thousands of employees with them. And this is my message to all of them. If you haven't done it for the first 6 months, hey, you haven't been spending in COVID either. You've got some money stashed away. So you can take a smaller net take-home paycheck for the next 6 months. Settle for it. Start early. Even if you're late, better late than never. Get that money into the NPS account. Next question.
So we actually, as I said, we have many questions today. So I'll take up all of those, starting from where we started the session one by one. So we have a query from Mr. Dulapudi. He says, is there a way to save taxes on agricultural profits or losses?
So, well, frankly, I'm not a chartered accountant. I'm not a tax expert either. But yes, agricultural income is, as far as I remember, it's exempt from income tax.
It's
There are
exempted.
conditions. It's exempted in any case. In fact, a lot of people fudge around with their real incomes and pass them off as agricultural incomes. And, I keep on hearing a lot of shady stuff like that. I'm sure Mr. Dolapuri is not in that category, of course. But the specifics of how to save taxes and whether agricultural income is exempt from tax, I think, sir, you need to speak with your tax advisor, tax planning consultant, your chartered accountant. My general knowledge tells me that it's tax.
Fair. So we have a question from Mr. Praveen. He's asking, can I switch between the old and the new tax regime? So probably he must have taken the new tax regime and now he wants to switch to the older, or vice versa. He wants to have some clarification on that.
That's a very good question, and the only way I'll be able to answer it credibly is by Googling it. I don't have the answer, let me confess. Swati, and don't trust my Googling.
As far as I know, you can, if you are a taxpayer, you can switch between old and the new tax regime once in a financial year.
Absolutely,
It,
yes, yes.
it is
Okay,
allowed.
that's good to hear.
And
I
yes,
stand
that is
in
the
your.
flexibility that's given to a common taxpayer.
Thank you, Swati. You saved my life.
So a lot of our audience is our corporate audience. So this is an information for them. The window is open from the employer once in the year, wherein you can switch your tax regime. So if you want to switch it, you can do it once in a year. That will go as an intimation to your payroll team, and that's how your taxation and your monthly take home will be calculated going forward. So hope
Okay. Okay. Next
Yes.
question.
Mr. Praveen. So we have a question from Mr. Pradyumna Belur. He asked, based on my recent research, I find that it is a bigger hassle to withdraw your own NPS. Would you still suggest it?
Okay, so I don't know about the hassle because now everything works digitally, including your withdrawal requests, right, Pratibha? And
Right.
from what I remember, the processing time for withdrawals has is also very low, less than 3 working days. I'm told many withdrawals have actually happened in a day. There are
Yes.
restrictions, and maybe you can't withdraw the entire amount, and you have to put it back or whatever. But I don't know the details there. Pratibha, maybe you can fill in for this bit.
Yeah. So to answer this query, what I would say is this particular investment is designed to ensure that your fund stays intact. That's one larger reason wherein your withdrawals or where liquidity is limited to several terms and conditions.
Yeah.
Now, given a situation like this, when we are not promoting you to make withdrawals, we are promoting you to actually retain the fund. That's the bigger reason why why the liquidity in this particular investment is very much restricted. It's a bigger hassle maybe because you have to submit a lot of documents. So if you are going for a partial withdrawal, which is allowed 25% from your voluntary contribution, so for that withdrawal of that 25%, you actually have to present the documents. So say for example, if you are withdrawing that 25% chunk for your children's education, so you need to provide us documents for that. Or maybe purchase of your house, so you need to provide us documents for that. So probably from that perspective you might find it a bit of hassle, but if you look at the bigger picture, if you look at it at a longer tenure, we are trying to promote, or we are trying to encourage you to retain the savings.
Good point. Good point. Yeah, I
Yeah.
take the point, but I would think it's my money. I should be able to pull it out. And if you're going to make it difficult, that sounds a little intimidating. But I see the larger value of putting the money away for a longer time. But
Also,
if you really need it, yes, Swati.
yes. Also, in fact, during this whole COVID time, it was, I think, allowed to take out money for any critical illness during
Yeah.
COVID-19, as it was for other instrument as well.
True, true. So I see the point that Pradyumna is making, but I also understand that one has to be, one has to have that mindset of saving for the long term and touching this money only when there is no other option left. I
Absolutely.
think that's
Yeah.
okay. Next
Not
question.
digging into a retirement kitty, as we earlier said.
Yeah, yeah,
Yes, yes,
yeah,
yes.
Pratibha.
So we have a question from Mr. Palani. He asked, after the retirement, to get the monthly base salary, where can I invest? Is there a government based scheme available for this? So I think, this
So
again comes to NPS.
yes, so the NPS, I think in NPS, if I remember right, although I haven't mugged it up too well, I think 60% of your corpus, all that you've saved and you've earned in those savings in NPS, plus the accruals and returns over the years, let's call it a corpus. So 60% of the corpus you can withdraw at one go, up to 60%. You can withdraw less if you want to, and it's all tax free at that point of time. The remaining 40% or more, if you've chosen for that, can be put into some 5 or 6 different kind of annuity structures for you, your spouse, and with various kinds of permutations and combinations. But yes, so 60%, up to 60%, you can withdraw. The remaining 40, you can even put the entire 100 into annuities if you want to. If that's what your monthly salary thought is like, you can do all of that. That's the beauty of the NPS. It's a pension system. You can get pension after 60 for the rest of your life. In various ways, you get it, and after your death, your spouse gets it, or you get it only so long as you live, and so on and so forth. There are different combinations. So I think you can go to the hdfcsec.com NPS product pages and figure out the various combinations. But the broader answer to the question is yes, an annuity is indeed possible, and that's the beauty of the NPS. With at least 40% of your money after 60. Yes,
one thing I wanted to know, maybe an information I wanted. So as you grow old, like you have invested in NPS when you were in 30s or 40s, and as you go towards your retirement, you can increase your annuity amount as well. So that you can have more.
So the annuities begin only after you hit 60. Till 60, you are in savings mode, and after 60, you are in returns mode, so to say. So the liquidity you get at the age of 60 is that all the money that you've saved from, let's say, from 35 to 60, 60% of that corpus is available to you at age 60.
Yes,
and the remaining 40 you can convert it to annuity. You can, of course, convert the entire 100% into annuity if you want to. There's no restriction on that.
That's what I wanted to know.
If you want the lump sum, then the max lump sum you can withdraw is 60% of your corpus. Okay, next question.
Yes. We have a question from Mr. Saurabh. He's asking, I have a health insurance which is covered by my employer. Should I buy another one? Also, can I avail the benefit of both insurances for the same hospitalization event?
So let me answer this question in a simple way. So there's the health insurance slide. I have said, look at the third point there. I hope you can see the slide now. Buy health insurance even if you have employer cover. Okay, I practice what I preach. I'm covered for substantially more than what my employer cover is. I don't want to just bask in. So one, of course, your employer can sack you whenever he or she wants to. Okay, but more important and more seriously, I think you need that cover, because sometimes the cover that your employer provides is of a certain kind. It doesn't cover certain things. It covers certain things. So you may want to cover other things with the cover that you buy for yourself. The second thing is, if you start early when you're young, your annual premiums are going to be much smaller. Now, whether you can claim from both policies or not, I think one policy should kick in at one point of time. Another policy will kick in after you exhaust the first policy cover, and that's how you should look at combining them with, that's my general advice to you. Yeah. Swati, I hope you're covered by Z Business and you have a health insurance cover of your own.
Of course, our organization is very responsible organization, one of the leading organizations we have. So yes, we are. But yes, having said that, it is very important not to just rely on your office policy, but you should have a separate policy as well, because insurance is very complicated. We need to understand each and every part of it. So having a sufficient insurance amount policy is very important. It's especially in today's time is extremely
there are so many health insurance policies that give you rising cover as you move forward in the future. There's a whole lot of combinations that are possible there. And like I said, don't just look at your employer's policy. Get your parents covered. You'll get another 25,000 rupee tax benefit there in terms of the exemption. But broad message, yes, you should buy a policy even if your employer provides you with health insurance. Next question.
Yes. So regarding ULIPS, Mr. Dev is asking, regarding ULIPS, is the bonus or endowment amount taxable?
I don't think so. It falls into EEE category, but I could be wrong. I think this is something we should do some homework on and come back. There are very few times when I wish I was a chartered accountant, and this is one of them. All right.
We can all gain some knowledge here, some information here, and then we can come back with more of it next time.
So Google it, Dave. I'm sure you'll get an answer, but I can Google it for you.
But that is the problem. Google also has loads and loads of information. It's like explosion of information. No one knows what's right or what's wrong.
Yeah, but here's the humble answer. So here's the humble answer. Nobody knows everything, and least of all.
Absolutely. And we should accept that.
Yeah, and this is an interesting question, and I will find out an answer. So sorry about that, Dave. Next question.
Errol is asking, does LTCG apply to ELSS?
So like I said, ELSS is completely tax-free up to 1 lakh rupees of annual income coming out of redeeming ELSS mutual funds. Beyond that 1 lakh, obviously it will be treated like a normal mutual fund return and will attract the provisions, the portion beyond the 1 lakh in a particular year. If you were to see any of your ELSS investments, any income from ELSS investments beyond 1 lakh rupees will be subject to long-term capital gains. Yes.
A linked question to ELSS from Mr. Abhijit. He asked, PPF versus 15-year ELSS, which one is better?
No. So ELSS is not 15 years. ELSS, the lock-in is only 3 years. You can take the money out even after 15 years if you want to and run it from 12 to 15. And you know, at the end of the 13th or 14th or 15th year, when you redeem your ELSS investments, then in that particular year, a return, a profit of up to 1 lakh rupees will be tax-free. The rest will be taxed at LTCG, for example. But to compare ELSS with PPF is unfair, because in PPF your money is actually locked up for 15 years.
Locked, yes.
There are withdrawals allowed as well. So which is why I said there are short to medium term instruments for saving taxes and saving your money and compounding your wealth. And then there are long term options such as NPS, EPF, PPF, and so on. So these are different buckets. Okay, these are different toys. These are different products. But yes, they're all covered under the ATC thing, sadly. On a year-to-year basis, when you put that money away to get the exemption benefits, they are clubbed together, but otherwise they are completely different in character. So you can take that ATC tax exemption limit from 1.5 by another 50,000 in NPS, and then another 5.5 lakhs more. But that I think we've already spoken about. But these are two different products, ELSS one and PPF the other, because they address different time horizons in terms of the benefits they give.
So maybe Dipen, what I'm trying to do is, I'm asking you another angle of the same question. So if I have to ask you in terms of maturity and returns, so if I'm still retaining my ELSS corpus, though the lock-in period is for 3 years, but I decide to keep it for 3 years and withdraw it after 15 years. So if I have two buckets, one is my PPF and one is my ELSS. So what kind of returns?
So I'm too much of an equity junkie here. The standard answer to give is that over 15 years, I'm absolutely sure that ELSS will give you better returns than PPF. But let me say this. That's just because I love equities so much. We think that equities will give us and should give us conventional wisdom. Historical evidence tells me that equities give fabulous returns over 10 years and more. Fabulous returns over 10 years and more. But there are exceptions. I don't know whether we are in an exceptional zone right now. It doesn't look to me that we are in an exceptional zone by any stretch of imagination. But as they say, risk supply. And if you have the appetite for absorbing equity risks over 15 years, they actually diminish as you move forward in time. That's what history has taught us. But mutual fund investments, what was that line, are subject to market risks.
Market risk, yes.
Absolutely. Read all offer documents before investing. Take it with a pinch of salt. But yes, I think a mutual fund should deliver much better returns than PPF over 15 years.
Fair, yes. So quickly taking up next question from Sai Pramod. Good overview of the main tax saving option. Thank you for organizing the webinar. My question is, there is a tax deduction for home loan interest too. Does taking a home loan help in net saving over the long term?
Yes, of course. A home loan is actually a very, very good, just because I have all the money to buy a home that I need right now. Let's say I'm lucky and I'm rich and I've saved a lot of money and I've got that liquidity to make 100% down payment. But it's always a good idea to take a home loan because there are tax benefits involved. It also leaves that money liquid for me. So let's say, again, I'm an equity junkie. I want to invest in the markets. What if I was to put this money into my home and then borrow money to invest in the markets? I would get it at 17 and 18%. Okay, so all money is fungible. If you've got better use for your money, now these are delicate questions. The answers are different for different people. Swati might say, no, Dipen, I'm not an equity junkie. I've got this money, I've got 50 lakhs saved away and I want to buy an apartment in Noida, or whatever it is. I might say, no, but you know what? I will put 10 lakhs down payment and I will borrow 40 lakhs home loan and I will get a tax break on it. Plus I will get tax break on, the installments that I repay plus some interest payout benefits and so on. And you know what? I've got 40 lakhs to play around with in the markets. That's my style. Okay. So figure out what your appetite is. Figure out your risk appetite. Of course, it makes more sense if your risk appetite is higher.
And if you can repay the loan, if you can repay the loan.
Of course. And if I have visibility for my salary income over the next 20 years, and if I'm young enough, of course I should take a home loan. But Swati, would you put those 40 lakhs into the equity markets?
Yeah, I mean, see, I think what will make sense is maybe what I think. If you're fairly young, you can surely take a home loan, get the tax benefit out of it. Then you can invest the money you have in the market, or where you can get the returns from also. So you can get dual benefit of investing the money and then get benefit of taxation also. So yes, it does depend on different.
So I'm happy to know I'm not the only equity junkie here.
It's about making wise decisions at right time. So that is all about it.
Yeah, so the timing bit is very important, because I think your appetite for equity should also taper off with age. So, my thumb rule, and this is something I'm happy to share with the audience. My thumb rule is that even if you are a reasonably good risk taker, it's a function of age. So when you're 25, I would use this thumb rule. The thumb rule is that 100 minus your age is the percentage of your wealth that should be in equity. So if you're 25, then 100 minus 25. So 75% of all my money can be in equity, whether it's in direct equity, whether it's in mutual funds, PMS, and so on. But when I'm 50, so let's say I'm 50 years old now. So even if I'm a reasonably good risk taker, it should just be 100 minus 50, which is 50%. And if I'm 75, my thumb rule is that 25% of my money at most can be in equities. Okay. If you are, of course, a less risk taker, a more conservative investor, then don't use 100, use 90 or 80 or even 75. And if I was using, if I was only 75% of a good risk taker, and if I'm 50 years old, then it's not 50%, but just 25%, 75 minus 50, which is the percentage of my wealth which should be in equities. It's a very, very good thumb rule to use. No matter what anybody else tells you. If there is one more message apart from the monstrous tax savings and investing benefits that you get out of NPS, if there's one more message apart from that I want to give to my investors and audience today, it's that use the 100 or 100 minus your age rule, or maybe 80 minus your age rule, depending on where you are on the risk curve. But investing in equities as per your age is an important tool to use in your financial planning journey.
Can someone who has can someone who has just maybe in his or her maybe late 50s or just retired can put more money in equity, because that person has no responsibilities or liabilities now, that person simply wants to enjoy his or her life, and because we all know that yes, we want to live up to 80 years or more, and we have another 20 or 25 years of our life left, when we don't have to marry off our kids or have to pay for their education or anything. So can that thinking change, or should we think differently about that?
So like I said, Swati, the answer is different for different people. If you have a higher risk appetite, even at 60, you will use the 100 golden number of 100 and say 40% of my wealth can be in equities. But if I was conservative and if I would choose 75 as the baseline, then 75 minus 60 is just 15% of my wealth should be in equities. It's a very, very useful thumb rule, I must confess, and I've used it for my own life. I've seen other people benefit from it, and of course put it to use in their lives. And yes, if you are 60, you can even put 100% of your wealth in equities, but you should have the stomach to digest it, to digest the ups and downs. You can break all the rules, but you should be gutsy enough to live with the consequences of calculations. Next question.
From Mr. Kamath, is it possible to extend NPS beyond 60 as the expense ratio is only 0.01%, which is much lower than any mutual fund?
Superb question. Yes, there is an extension possible at 60. I think it happens in intervals of about 10 or 15 years, Pratibha. You can take extensions of.
Post completion of 60 years, you have an option wherein you can extend it to an age of 70 years. So if you are not wanting to take a maturity at the age of 60, you can take it at 70 years or anytime before 70 years also.
Oh, so up to 10 years. I can extend it by 3 years if I want to. I can extend it by 9 years if I want to.
Yep.
And let's say I'm 70 now and I want to extend it again. Is that allowed?
No, that won't be allowed.
I'm planning to live to 100. I want to do it 3 times or whatever. But
so
anyway.
NPS assumes that you'll work up till 70 and then just be happy with it.
When you really need the annuity or you really need this lump sum. But Kamath's a very, very good question. See, the beauty is Mr. Kamath noticed that the fund management fee is only 1 bp. I think more than the extendability of the scheme, Mr. Kamath was sharp enough to notice this. Congratulations. Welcome to the Kanjus Club. That's the only word of Hindi I've used in a long time. Okay.
Question from Mr. Jignesh Sangvi related to asset allocation and equities and debt. Hi, in NPS, should we select the PAC all funds and debt option or 75% equity and 25% in debt, which will benefit in long run, taking into consideration market conditions?
Yeah, so this is again personal tuning is what should matter here. Since you are going to put your money away for 20-30 years, I think going 75% into equity is a good idea. But having done that allocation, just see whether in your overall wealth, are you in that 100 minus your age limit for equities? And of course, if you want to make it 120 minus your age, or you want to only be equities and you're a junkie like me, then go 75% into equities, Jignesh. It's as simple as that. But yes, I think these are individual decisions that one has to take. Find out the answer for yourself by using the thumb rule that I just mentioned. Otherwise, do what you please. You can always change your mind later. NPS allows you to change the equity to debt blend from 75 equity all the way down to 0 equity at will, any number of times, right, Pratibha?
Yes, absolutely. You can do it twice. You can switch between funds twice in a financial year, and you can change your pension fund manager once in a financial year.
Lovely, lovely.
Yeah.
Last question, or do you have more?
Yes, we have actually many more which I'm answering during the conversations. But since we are running out of time, I'll take one last question. Mr. Lakshmi Narsimhan. He says, I have a corporate superannuation scheme as well as NPS corporate scheme currently enjoying the tax benefits on both. My thought process is to transfer the superannuation corpus to NPS just before the retirement and combine both the corpus together for annuity. Does this make sense?
If it works for you, yes. I think the corporate superannuation can give you a lump sum of up to 100% of the corpus. But if you shift it to the NPS a few years before, then be prepared to take 60% of the corpus from the NPS bucket, right?
So, yeah, so what I understand, Dipen, is what I know about superannuation is that it gives you a liquidity at the time of maturity. It gives you a liquidity of 2/3 of your corpus value. All right. So when so when you actually add your superannuation corpus to an NPS corpus, first is your corpus actually swells up. So if your current corpus was, say, was an X and your superannuation is Y, so you actually get a swelling of X plus Y, which is an exponential value. And then you have a liquidity of 60%, which is absolutely tax-free.
So even the superannuation liquidity would have been tax-free.
More or less, yes.
And you were going to get 2/3 of that as a lump sum in any case. I assumed it was 100%,
Yes.
but I stand corrected. So you're just changing the Y bit from being 66% liquid, 66 and 2/3% liquid, to 60% liquid. Where is the material difference, Pratibha?
So 2/3 is that's what I understand. That's what I've been understanding over these many days. That 2/3 is the value which you get, and there is some tax angle also to it. So what I can
There's the
do
tax
is
angle. So yeah, I think we can get back to Mr. Narasimhan on finer details of this.
yeah.
So again, it's embarrassing to be stumped like this, but this is another brilliant question. And let's get into a little bit of detail on this. And if he can write to any one of us, if he can write to our customer care
Yes.
and mention you or me, we are happy to explore this question and maybe take the wisdom that we gather when we answer this question to the rest of our investors and customers as well. I have Mr. Narasimhan to thank for this. I think it's a very humbling note on which we need to end this webinar now, because Swati, this is the second very, very sharp and intelligent and detailed question that we are getting on this webinar.
Yes. I'm very glad that we are able to do what we are doing right now, and we are able to make clear a lot of complex tax related issues here, and people are actually understanding all of it very intelligently and taking out the minute details of it. That's very nice, and I think that solves the purpose. That is actually we are getting towards it of
Swati,
how to do intelligent tax planning is all about.
Yeah, so that's what a hack is. A hack is a nerd, is a kida, is diligent and persistent and goes down to the details and the nuts and the bolts. And there are so many nuts and bolts that we need to crack open and figure out how to do things sharper and better and smarter and faster and more lucrative. I think it's been a great experience. I must thank Swati and Pratibha for this session, but most of all, I must thank the audience for making this most educative for me and a humbling experience. There are so many good, solid people out there who are figuring out the minute details on how to hack taxes, as it were.
Absolutely. In fact, not only on this webinar platform, but a lot of questions on other platforms where we have promoted this webinar. A lot of questions are coming there too, but I'm sure maybe I'll forward it to you and just you can answer those questions and how people have enjoyed this session. And it has been a very good session. Thank you for having me here. It was actually a great pleasure indeed, and an insightful session for me as well to learn new things also, because there are a lot of things that I have also come across today.
Okay, Pratibha, we are good to go. Bye.
Thank you so much, Dipen. Thank you so much, Swati. Thank you so much, audience, for joining.